Hello YouTube, it's your boy Joseph. Welcome to the Common Investor channel, and this is a Freetrade investment ISA portfolio update, episode number 12. As usual, just gonna take you through my stocks and just to kind of tell you what I've been adding, new additions, the biggest increase, biggest decrease, in terms of value, any holdings I've put more money in, and any holdings I've reduced significantly. So as of today, my portfolio is valued at £14,010, 43 pence, and obviously I'm up £1,104 pounds and 74 pence. So over the past month, my portfolio hasn't really gone anywhere. It's just been nice and stable, which that's not a problem for me. As long as it's not going down, that's I'm happy with that essentially. I think the most has been during the increase was about £1,800 essentially. So there's been a decrease of about £700, but I'm fine with that. There was little glitch here, which was my mistake. That was corrected by Freetrade, and yeah, so no money is basically left the account, and no money has gone into the account for the past couple of months. So essentially, what you're seeing is actually either increased by dividends or increased by actual capital gain. So you're seeing a true reflection of the portfolio essentially. So so in terms of stocks I've added, I believe six new stocks since you last saw this portfolio. So I'll take you through them one by one. So SMT, which is Scottish Mortgage Trust. I'm down. I added today, and I'm down 0.69%. What it is basically is it's an actively managed low-cost investment trust that invest in good companies listed around the world. It pays a 0.3% dividend, and it pays this twice a year. So, these good companies are typically what you would call, disruptors. As people say, there are two sides to the markets now. So those are the long-standing companies, and then you got disruptors. So this trust essentially holds companies like, so the biggest holding it's got is Tesla. And obviously everyone knows Tesla. Tesla is about $1,200 right now, and people say it's going to go to $2,000. And for me, just to kind of minimize the risk of Tesla dropping, because people seem to think that's the actual value of Tesla. I'd rather invest in companies like that through this trust. So this includes Tesla, which obviously which has a weighting of 11.10%, which is quite a lot actually. You got Amazon as well, which got a weighting of 9.30%. You got Illumina, you got Tencent, you got Alibaba, you got Delivery Hero, you got. So I'm just picking up some. I'm looking through the top 30 holdings as of 31st of May. I'm just looking through companies that I do know. So he's got Netflix, he's got Ferrari, he's got Nvidia, he's got Spotify, he's got Alphabet, he's got Shopify, he's got Zalando, he's got HelloFresh, Wayfair, Intuitive Surgical, which I think went up like 4% today or something. It's got Zoom, and it's got VIR Biotechnology. So it's got basically quite a few companies that I would like to invest in actually from a group point of view. And I'm just minimizing my risk by investing in this trust. And it's really quite cheap in terms of the ongoing cost. I think it's about 0.36%. So that's pretty good in my opinion. I basically bought 126 shares today, and I'm hoping for an actual dip. And if there is a dip, I would definitely be putting more money into this. I just bought it now because I feel like there's nothing holding it back. According to from the price to book um, ratio, this is, well, not price to book, more like the NAV ratio essentially. Then this is it's like you're buying it as a premium because it's basically above one. If it's less than one, then you tend to we tend to say that it's a bargain essentially. But if you look at simply Wall Street as well, if you look at the in terms of from a valuation point of view, it does say that this is cheap. You're getting it at I think 16-17% discount at the moment. Um, so depending on how you look at it, to be honest with you, for me, someone might say it's from a price book value, which is basically the NAV ratio, that that's um, that's overvalued, or you can look at it um, through the stock price essentially, um, and calculate the cash flow, estimated cash flow, and see if it's if it is how it is valued. So for me, I believe it's considering the companies it holds in it, and the basically the value you get in with the trust. To me, I'll say it's fairly valued. It's definitely fairly valued, and it's something I feel like is going to go a lot higher, as long as obviously this growth stocks, which it has wonderful growth stocks, keep on going higher and higher and higher, which I don't see them stopping anytime soon. So the next one is Raytheon. And SMT is actually my growth play essentially. I don't think I'll be buying any more growth stocks. I'm just gonna stick to that. It's got everything I want and everything I need. The next is Raytheon. So I'm down 12.2% on Raytheon. I bought it when it was around I think $71 or so. I've bought a few more after that. Yeah. So Raytheon, as everyone knows, is probably does know, is a military contractor that build radars, aerospace systems, missiles. Currently, they're undervalued, but quite a bit actually. I mean, analysts is basically saying they should be around, a $70 to $80 range. And right now it's around $61. And at some point, I believe, yeah, it was around 50, up in the 50s. So yeah, I mean, from a valuation point of view, I believe it's definitely better value. They generate similar revenue to Lockheed Martin, but Lockheed Martin is basically, I think, well, last time I checked, it was around the $100 range, and and yeah, and also from a valuation point of view, because they do something similar to Boeing as well, from in terms of making airplanes, but they focus on smaller planes. They are a lot cheaper as well from a valuation point of view. Obviously, the COVID-19 has impacted pretty much a lot of businesses like this, but the CEO has basically said they're expected to be back in the growth phase in the next 2 years, and they basically promised as well to continue paying dividends till then. So, and as of right now, they pay a 3.1 dividend and they pay this quarterly. So I mean, I did buy it at a slightly higher value, but I did get this for the dividends, and also because even at that price, it was still undervalued. So over time, I'll be increasing my holdings in this, as I think it's quite a good dividend play, and potentially also moderate growth play as well. Then the next one is EMIS Group. Which I am currently up 1.33%. Got this about a couple of days ago. So I'm not going to go too much into this, but it's the ecosystem. Basically, they term themselves as the ecosystem on for healthcare in the United Kingdom. I've done a video about this already in terms of reviewing the stock, so I'm going to put a link in the description or somewhere within the video, and so you can always just click on it, and it should take you to the video. So I hope you enjoy that. That's my first review or stock analysis, so hopefully it gets better after that. It pays a dividend of 2.93%. They've been increasing this dividend consistently since 2011, and they pay this biannually. And in some cases, you actually get two dividend increases in a year, so that's pretty good. And yeah, that's pretty much it for this one. So the next is Tate&Lyle. So Tate&Lyle is something I had before. It's kind of went up a bit, then I sold it off, and it's come back down again. So I've bought it again, and I'm gonna keep it this time because I've been able to add a substantial amount into this stock. So you know, yeah. So I'll be keeping it now. So as everyone knows, right now I am down 1.25%, and you know, Tate&Lyle is basically provides ingredients and solutions to the food and beverage and other industries in the United States, United Kingdom, and other European countries and internationally. They pay a 4.4% dividend, and essentially it's just a staple in you know in the in every investor's dividend portfolio. You know, if you do invest in dividends, they have a really good balance sheet. They have the revenues basically and earnings are basically maintained over a long period of time, and they also do dividend increases as well. And it's been quite just as a company, it's been quite stable for a long time. So this is one of them good dividend companies essentially. The next one, yeah, I'm not going to go too much into Tate&Lyle. It's a lot of videos on YouTube about this. If you want me to, then please just let me know. Align. So the next one is Align, which is somewhere down here. So there's a problem with averaging into stock sometimes. I start small and I build up my position, but yeah, I mean, look at this. It's literally up 15.84%, and I've only got £11 in it. Yeah. So sometimes it's just good. Sometimes it works better just to buy it as a whole stock. However, I kind of believe that this is going to, I believe this is going to drop again. So if there's a second wave, yeah, 'cause I don't see how with dentists is basically how this will work essentially. Yeah. In case of people that don't know about Align Technology, they are a medical device company. They design and manufacture, they design, manufacture, and market Invisalign, which are clear aligners, and intraoral scanners, and they provide services as well for orthodontists and general practitioner, dentists, and restoration and aesthetic dentistry. Currently, they pay no dividend, classed as a growth stock, and it's done pretty well over the past couple of years. A similar company to this is Smile. However, obviously, Align is a much bigger company, and basically they're from an earnings point of view, they're profitable. Smile isn't still profitable yet, but it's still in the growth phase, and it's a lot cheaper than this as well. They provide a similar product to Invisalign, which is provided by Align Technology. So that could be a stock to look into as a play to Align Technology. I've just kind of my approach has kind of changed over the years. I tend to just kind of go for the biggest in the game and just stick to them. And that way you just kind of have consistent growth over time. There are a lot of data centers or a lot of antivirus softwares and all that kind of stuff. So to me, I try to anyway just go to the biggest in the game and just stick with them, which is why I've kind of just stuck with Microsoft. I'm kind of going on a tangent right now, but I've stuck with Microsoft just because I believe basically it covers most of the tech stuff, and then I add this bits and pieces into the portfolio every now and then. So the last new addition is Ocado. So Ocado currently I'm up 0.31%. Just added it because there was a bit of a dip essentially. Where is it? Yeah, there's a bit of a dip there when it went to about £20. I think it's definitely a company for the future. I mean, they've been doing pretty well since 2011, and it's just been growing, 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 growing. I feel like it's overvalued right now, but I'm just banking on the fact that the trend of ordering food, or doing your grocery shopping online sticks after the COVID-19, the COVID-19 vaccine has been released, and everything kind of goes back to normal. So that's what I'm hoping for, essentially, because even I was kind of against buying groceries online for a reason. Clothing, I've changed. Clothing, a lot of my clothing I buy online now. I don't really go to the high street anymore. But for grocery shopping, I just like the feeling of holding my bananas or holding my apples and pears, or vegetables, and it's a bit therapeutic pushing the trolley about, all that kind of stuff. So it kind of gets me out of the house as well. So that's good. So that's the last one. If you don't know already, Okada doesn't pay any dividends, and they operate an online grocery as an online grocery retailer in the United Kingdom and internationally as well. So from an increased holding point of view, in terms of where I've kind of put in more money for stocks that I previously held, that would have been Pfizer. Where are you? Yeah, I increased my holdings in Pfizer this month because there was a drop, essentially. Yeah, there was quite a drop there. So it dropped to about $32, and I started buying in around there. It's jumped up because Pfizer basically ahead of they've done some clinical trials, I think, on like 24 people, and everyone within the trial basically developed antibodies for the virus. So it's not been peer reviewed or anything like that yet. It's just raw data, and yeah, people took a liking to that, and Pfizer jumped a bit, actually, thanks to that data. So, but according to the actual data out there, I think Pfizer is pretty much ahead of the gang. So, and you actually have quite a few companies that have delayed clinical trials for their vaccine. So that's good news from Pfizer. I've reduced my holdings in BP. I sold. As of today, I was down about 14%, and I probably made a loss of about 150 quid or so. But the reason I sold BP was so that I could buy SMT, and I basically thought about it in the sense that I'm going to recover my money a lot quicker, and my money's going to work a lot harder for me in SMT than BP. So, I mean, BP had some, I think, relatively good news this week, where they reported that they've sold their petrochemical business to some billionaire or millionaire, and yeah, that kind of sent the stock going up a bit to, I think it was a 3-4% increase to about 315, and but it just basically dropped back down again. Like, I just kind of lost hope. I was like, you know what, yeah, I'm just gonna sell it off and invest in something that's it's just gonna work better. Sometimes you're just gonna cut some stocks off, yeah, I mean, a lot of people have lost hope in the oil and gas industry. So what's the point of just of holding so much a huge position in BP? I just sold it off and invested it in something that's in the future and something that's growing. So hopefully that strategy works for me. Yeah, and sometimes you're just gonna cut some stuff off. And also from a capital appreciation point of view, I think my biggest increase this week has been Upwork. It's down here. Yep. So Upwork is basically a profession. It's similar to Fiverr, just more professional in terms of they actually look for people, professionals that have degrees and all that kind of stuff, to they get them on their books and keep them on the payroll, which is obviously more expensive compared to Fiverr, where it's really like freelancing, where any Tom, Dick, and Harry can basically just go onto Fiverr and advertise and get a job or whatever. But yeah, Upwork is definitely a more professional service. So if you go to Upwork, you know the standard of your work is going to be, top notch. That's what's expected, anyways. So right now they're profitable compared to Fiverr, which isn't profitable. However, Fiverr is actually growing a lot quicker. Obviously, it's got a better brand name. A lot of people know Fiverr a lot more. But Upwork, I feel like at this point in time is a more reliable company. I just like the fact that it's from an earnings point of view, it's making money, and revenue is growing as well. It's not just growing as quick as Fiverr, but then it is also a bigger company than Fiverr at the moment. So yeah, that's it. And also I talked about Raytheon technology as well. So Raytheon technology has been my where are you? I've had the biggest decrease in value over the past month. I think this is just an after effect of people being scared that the second wave is coming, and people just kind of sold off a bit. I don't have any problem with that. Raytheon was overvalued when I bought it. I'm just gonna average it out and just rip off the dividends essentially. So yeah, don't have any problem with Raytheon going down. It's something I believe is going to be a lot better in the next couple of years. So I'm not going to be selling this. I'm just going to be holding it on as for the long term. All in all, I'm pretty happy with my dividend portfolio actually. I feel like it's a pretty solid collection of dividends. It's not a dividend portfolio, I guess just my free trade portfolio. But there are a lot more dividend stocks here than there are growth stocks. Um, but I'm happy with it. It seems to be holding up pretty fine, and yeah, I hope everything goes okay. And I hope the second wave doesn't come through. I hope the economy continues to grow, and I just hope everyone's nice and safe and healthy. So thanks for watching, and if you like the content, please subscribe. If you like the video, like as well. And if you want me to review anything in detail, please just let me know, and we'll do that. I'm gonna come up with a few more series, which will include, when we get into the earning season, which is pretty much around now, I guess. We'll kind of be updating earning dates for different companies. It's something I just thought about. Might also be maybe when dividend payments are around the corner as well, or dividend dates, then updates on that as well. So it's something to think about, just to kind of change it up a bit. Obviously, I've started to do reviews or stock analysis, and if you have any constructive criticism, please let me know, and I'll try and work on it. So yeah, then again, thanks again, and so I've never got a free share from doing this. So I'm not asking you to do anything, but if you can, I'm gonna put my Trading 212 free share link on there, and a free trade free share link as well. So please do a brother a favor, and just one person, okay? But anyways, it's not by force. If you don't want to do it, that's cool. Obviously, you got family and friends that you might as well do that with. But just thank you for watching the channel, the portfolio update.